Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the Acca tutor, Mr. Jerry Mtumkulu. In this video, I'm going to take you through our first um, lecture on Acca paper financial management, where we'll be looking at the financial management function and working capital management. Remember, as you have always known, that our our period of study to cover the syllabus is just 2 months. Okay, in less than 2 months, we just have to ensure that we have covered all the aspects of the syllabus, such that in the remaining 2 weeks or so, or let us just say for a month, we just do the revision part of it. Okay, so in this video, we are going to touch on those introductory tenets concerning financial management. Now, the nature and purpose of financial management. Financial management can be defined as the management of the finances of an organization in order to achieve the financial objectives of the organization. So when you are talking of financial management, we are basically looking at the management of the company's finances. All right. So the usual assumption in financial management for the private sector is that the objective of the company is to maximize shareholders' wealth. So whatever decision a finance manager has to make, he has to ensure that the maximization of shareholder wealth is the central core. Now we have got 4 decisions which we need to be able to proffer given whatever situation if we are financial managers. Okay, so there are decisions which we are expected to be in charge of. Okay, the first one is investment decision. All right. When you're talking of investment here, we are basically looking both the short term and long term investment decisions. So you as a finance manager, you just have to be in a position to come up with viable and solid decisions concerning investments. All right. Now, there is also the responsibility for financing decision. And when we are talking of financing, we are referring to the sources of finance. How are we going to obtain our finance, and in what mixture or proportion shall it be? Shall we be financed by equity or shall we be financed by debt? That is another decision of the finance manager. Okay, remember when we talked of investment, we are referring both to the short and longer term, but we are basically referring to the expenditure part of it. Okay, what shall we expend the company's finances on? All right, what shall we buy? What shall we dispose of? At what value? Okay, and what are we expecting in return? That's the investment decision. But now when you are looking at the financing part of it, we are saying what sources shall we engage? Where do we get the money? What amount of debt shall we have as a company? Okay, or what percentage of debt shall we accommodate? Okay, what percentage of debt shall we accommodate with respect to the total capital? Then dividend decisions. How often shall we pay dividends? In what pattern? Shall we pay constant dividend or a growing dividend? Sometimes shall we pay a staggered dividend, or shall we not pay dividends at all? Okay, what are the what are the expectations of our manager, our shareholders? Do they want dividends in the form of cash, or do they want dividends in the form of shares? Okay. If we do not pay dividends, what is the reaction of our shareholders? All right. So those are the decisions concerning dividend. Remember, dividend is that return on shares. Okay. The monetary or the appropriation of the company's profits to the owners. All right. When we decide to just pay back to the owners of the company, we pay them in the form of a dividend. Okay, so it's the share of the profit that is given to the company's shareholders. Then, lastly, there is an aspect of risk management. Okay, when it comes to risk management, we are simply saying what are the possible routes to mitigate our risk exposure. Okay, risk is just the chance or the probability that something might happen. Chance or probability that something bad or good may happen. Excuse me. So it is different from uncertainty in the sense that we can quantify risk. All right, we can quantify based on our past experiences. For example, we really know from our trade operations that in June and July we expect higher sales. I mean, high sales in terms of the selling of winter stuff. All right, and during the summer we expect that t-shirts and other lighter clothing are usually bought. So that's we know from previous experiences that something is going to happen. All right, so how do you manage risk? Or why do we have to worry about risk? We need to worry about risk because we are not operating in a perfect market. All right, sometimes we do not have enough information about something, so we need to manage to come up with a policy or to come up with a mechanism to ensure that should a bad thing or should the worst case scenario result, we are having these possible routes or pathways out of the problems. So that's risk management. All right, the idea of transfer, the idea of avoid, okay, the idea of prevent, the idea of those ideas. Okay, there is what is called the TARA framework. Okay. Okay, so basically when you are talking of the TARA framework, we're simply saying sometimes you need to transfer the risk. Sometimes you need to avoid the risk. And then R is for reducing the risk. Sometimes you reduce, and sometimes you need to accept the risk. Okay, that's the TARA framework. All right, but basically the major issues we'll be covering in this risk management is the exchange risk management. Okay, exchange risk. All right, exchange risk management and interest rate risk management. Those are the things as finance managers we are expected to be responsible of. Okay, so this is actually the backbone of our course so far. We are expected to excel in investment decision making, financing decision making, dividend decision making, and risk management. So the whole syllabus is centered on these four decisions. Now, in taking financial decisions, the financial manager will need to take account of the organization's circumstances, its financial objectives, and commercial direction. Otherwise, if you simply try to copy and paste what was happening in another organization into your current organization, you discover that you end up being in conflict. So you need to tailor make your decisions so that they suit the objectives of your current company. You also need to consider the broader economic environment in which you are operating, in which your company is operating. Otherwise, you are also going to lose the point. Then lastly, you need to take account of the potential risks associated with the decision and methods of managing that risk. All right, so whatever package you're going to employ in managing risk, make sure that it is tailor-made to your specific circumstances. Now, excuse me, let's look at the strategic perspective. When you are talking of strategy, this is the course of action the organization might adopt in order to achieve its objectives. There are three main levels of strategy within an organization. There is corporate strategy, which is the general direction of the whole organization. Then business strategy. This is something that is linked to strategic business units of the organization. All right. It speaks out, or it spells how the organization or its business units tackle particular markets. All right. Then operational or functional strategy. This is now strategy which is specific to the energy departments or subdivisions or functions. All right. For example, we might be having the production. For example, production strategy or marketing strategy. And being operational, we are referring to this at implementation stage. Okay, at implementation stage, for example, at branch level. This one, the business is usually mid-tier. Okay, it's usually mid-tier or mid-management strategy level. Okay, and then the corporate is usually at board level, board or apex level, at the top management. Those are the ones which deal with corporate strategy. All right. However, these strategies should actually be, one way or the other, designed to complement one another. They should be in a way complementing one another. We do not want to see a mismatch, or we do not expect to see the strategies, the corporate strategy and the operational strategy conflicting with one another. Okay, let's talk of corporate objectives. Corporate objectives are those which are concerned with the firm as a whole. The objectives should be explicit, quantifiable, and capable of being achieved. Remember the SMART criterion. Objectives should be SMART. Okay, what does that mean? Okay, SMART simply means that the objectives should be specific, not vague. they should be measurable or being quantifiable. For example, we need to achieve a gross profit margin of at least 20%. So if there is that measure, then the managers would know what to do. Okay, and they should also be able to measure if they are attaining that or not. It should be achievable. Okay, it should be achievable. That is realistic. We do not want an out of this world objective, something that needs angels from heaven to meet or to sustain. All right. So individuals, if the objective is far-fetched, then individuals might, resent to implement it, might feel demotivated because the target can't be achieved. Or sometimes this objective need not to be too easy. So if it becomes too easy, then the achievability of the objective by the end of the day starts to demotivate them. Okay, so in as much as it should be achievable, it shouldn't be so easy to achieve, but it should be achievable, which means it should be real, a real objective with a commercial substance. All right, then we have got an R. The R here is for relevance. The objective should be relevant. Relevant in the sense that we do not want an objective that is wayward, okay, that does not address our specific needs, our specific circumstances. It should be relevant to the corporate strategy as a whole. Okay, it should be relevant to the corporate strategy as a whole. All right. Then we have got a T here, which stands for time bound. Time bound. The objective should be within meeting the objective should be within a certain time frame. It should be known that by such and such date we should have achieved so much tonnage in terms of production. Okay, we should have reached this far by this time. So there should be some time period. Okay, so the objective should be time bound. Right. Now, the objectives of an organization should relate to key factors for business success. Okay, sometimes these ones are called key success factors. All right. All right. Key or critical. Key or critical success factors. All right. We need to see these objectives meeting our profitability requirements. For example, we need to see a certain percentage or achievement towards our return on investment. All right, we expect an increase in the market share. We expect to grow as a company, to expand. We do not want to remain a one-shop retailer forever. We want to have as many branches as possible being opened for us. Then we need a growth in cash flows. Our customers should be happy. The quality of our products should be outstanding, and we need to have good relations in the industry, and we should have value added to our production or our operations processes. So these are actually the critical success factors within an organization. And when these factors are positive and are on a rise, then we can give a thumbs up to our managers. Now, the financial objectives. Financial targets may include targets for earnings per share, dividend per share, gearing, profit retention, operating profitability. The usual assumption in financial management, as we have already pointed out, is the maximization of shareholder wealth. All right, the wealth of the organization, the wealth of the shareholders in a company comes from the dividend or dividends received, the market value of the shares. A shareholder's return on investment is obtained in the form of dividends received plus capital gains from increase in market value of the shares. So which means to shareholders, they expect the dividends plus a rise in the share price. So those are the two things which they want. If those things are actually happening, then the shareholders are so happy. So there is this particular formula, ladies and gentlemen, for the total shareholder return. All right, we have got R is equal to C plus PE minus PB over PB, where R is the total return over the period and C is the cash payments received during the period. And when you are talking of this cash payment, we are simply referring to the dividend which has been received, because to shareholders there is no other cash payment that they receive except from the dividend which they would have received from the company, due to their shareholding. Then the PE is the ending price of the investment, that is the price today, the market value of the investment today. And then PB is the market price of the share at the start, when they started having their shares in this particular company. So in essence, total shareholder return is equal to dividend per share plus change, okay, plus change in share price over share price, okay, at the start, share price at the start of the period. Okay, and when we are talking of this change, the change is the price at this price today, the ending price, okay, price at the end of the period minus price at the start of the period or the beginning of the period, as you have seen in this particular formula. So let us look at this example. The price of stock at the beginning of the year was $60 and a dividend of $2.40 was paid. The price at the end of the year was 69. Calculate the total shareholder return. And total shareholder return, we said it is TSR. All right, TSR, which is equal to the dividend per share was 240, okay, plus the change. The change is determined by the price today, okay, or the price at the end of the year, which is 69, all right, minus price at the start, which is 60, all over the price at the start, which was 60. And you can see that the total shareholder return is 0.19, which is about 19%. Okay, that's 19%. That's uh, the return. Okay, somebody might ask and say, why are we happy about the total shareholder return, or why is this ratio called total shareholder return? Okay, this ratio actually is called total because it is involving two returns. Okay, it is involving both the current and the capital return. So in the exam, the examiner might ask you to determine the current return of the share or on the share. All right, so or on the investment. So what you do is you need to come up and say, you need to break up the TSR. Okay, breaking up the TSR. Okay, we know that the dividend was 240. Okay, and the initial price of the share at the start of the year was 60. All right, so plus 69, which was the price now, minus the price at the beginning, 60 over 60. We are trying to break the TSR. So you can see there that 240 over 60 is equal to 4%. And 69 minus 60 over 60, that's 15%. So our TSR was the TSR was 4% plus 15%, which gave 19%. This one is the current return, whereas this one is the capital return. So shareholders are happy when both these returns are increasing. When the returns are increasing, they are happy. They like that. Okay. Okay. So basically, the current return is telling us about the profitability of the company. All right. In the short term, whereas the capital return is telling us about the movement in the share price, which is something that is long-term forecast. All right. Now let us now look at the discourse between wealth and profit maximization. All right. Why is it the overall objectives of financial management is to have wealth maximization at the core instead of profit maximization? Okay, wealth is not profitability. Okay, wealth and profit are different. All right, so the idea is we simply need wealth, not profit maximization. So we are not saying profits are bad, but we need to actually be cognizant of the fact that having profit on its own does not make somebody richer, okay, or does not necessarily mean that they have adequate wealth. All right. Although profits do matter, they are not the best measure of the common achievements. Accounting profits are not the same as economic profits. Accounting profits can be manipulated to some extent by choices of accounting policies. For example, provisions. All right. So, which means uh, to some extent, um, we might lower the provisions, okay, just to ensure that our profitability is maintained. Okay, so accountants just use judgments to ensure that they temper around with the level of expense. So that on its own might uh, help the company's, bottom line to be attractive. Whereas in its or on its balance sheet, in terms of uh, the money in the bank, you will discover that although the company was profitable, it had no money. So making profit does not mean that you have created money or you have created a cash flow or an equivalent cash flow. It doesn't work like that. All right. Profit does not take account of risk. Shareholders will be interested in the level of risk, and maximizing profits may be achieved by increasing risk to an acceptable level. Sometimes because we want to be profitable, we end up taking so much risk, okay, to the expense of the long-term survival of the company. So it is our ability to manage risk that will see us tame the tide. Profits on their own take no account of the volume of investment that it has taken to earn those profits. Profits must be related to the volume of investment to have any real meaning. Hence, we need ratios like the return on capital employed. All right? Or the earnings per share. Sometimes the dividend yield, okay, which is the DPS over the market value of the share. So these ratios, although they have the accounting profit within them, they are considered extra measures, okay, or additional measures in our evaluation to see if the profitability is actually reasonable. All right. Profits are reported every year with half-year interim results for cottage companies. They are measures of short-term performance, whereas the company's performance should ideally be judged over the longer term. So when we are talking of wealth maximization, we are talking of the sustainable profits, all right, sustainable survival of the company, the longer term survival. Earnings per share. Earnings per share is calculated by dividing the net profit or loss attributable to ordinary shareholders by the weighted average number of ordinary shares. Earnings per share is widely used as a measure of the company's performance and is of particular importance in comparing results over a period of several years. A company must be able to sustain its earnings in order to pay dividends and reinvest in the business so as to achieve future growth. Investors also look for growth in the EPS from one year to the next. Let us look at example Garrett and see if we can make something reasonable out of this presentation. Garrett made profit before tax in 2008 of 9,320,000. Tax amounted to 280,000. The common share capital is as follows. Ordinary shares 10 million shares, $1 each. That is worth 10 million. 8% preference shares, 2 million. And we have a total share capital of 20 million. Calculate Garrett's EPS for 2008. Okay, so we come here. Remember, the formula of EPS was net profit, okay, or loss attributable to ordinary shareholders divided by the weighted average number of ordinary shares. So, what was our profit before tax? Profit before tax. The profit before tax was 9320. Okay, and the tax was 2800, and we get our profit after tax. The profit after tax was 6520. Okay, and we need to remove the preference dividends, preference share dividend. Okay, the preference shares were quoted 8%. Okay, 8%. This is the dividend. Okay, and 8% of 2 million. Okay, and we have 160,000. All right, and although, okay, this point is actually very, very important. The point is actually very important. The preference shares, although they declare dividends, the dividend of preference shares is not the same as that of the ordinary shares. So they are almost like a liability to the firm. Okay, because the dividend, their dividend does not go to the ordinary shareholders, but it goes to those preferred shareholders. All right, so this is why we first deduct them from our profit after tax. Then we have got earnings attributable to shareholders. These are the ordinary shareholders, okay, to ordinary shareholders, which is the remainder. Now, the number of shares we have now, the number of shares, remember we are talking of ordinary shares, number of ordinary shares we have in the company. According to the question, we have got only 10 million. There have been no issues during the year. So we have got 10 million shares. So obviously, the earnings per share is the earnings attributable to shareholders after tax. Okay, the earnings attributable to shareholders, right, over the weighted average number of shares. So the weighted average number of shares is 10 million, and the earnings attributable to shareholders, that's 6.3. So if we divide 6.3, 60 divided by 10 million, 63, 6,360,000 divided by 10 million, we get the earnings per share of 0.636 dollars, which is equal to 63.60 cents. Usually it is the standard for the EPS to be shown in cents. Okay, that's standard. No, financial accountants usually prepare those financial statements, exhibiting the earnings per share in terms of cents. It's like some international practice. All right, that is the case, ladies and gentlemen. Now let us look at another example here. Binya made earnings attributable to shareholders of 8.25 million in 2008 and 8.88 million in 2009. The company's share capital was 12 million ordinary shares of $1 each in both years. Calculate the EPS for 2008 and 2009 and EPS growth in relative and absolute terms. Okay. One thing you have to know is when you're talking of relative growth, we are simply referring to the proportional, or in percentages. We are referring to the proportional growth, or growth being presented as a percentage. But when you are talking of absolute terms, we want to know the actual money, the actual increase in monetary terms, the actual amount. So that is what we will be referring to. Okay, now let's start the computation. Remember, earnings per share is equal to earnings attributable to ordinary shareholders over the weighted number of ordinary shares. So simple, isn't it? Now let's calculate the earnings attributable to ordinary shareholders first. Okay, earnings attributable to ordinary shareholders. 2008. For 2008, we are told that these were 8.250. There's a dollar sign on top. And then the number of ordinary shareholders, we are told it did not change for the 2 years. It was still 12 million in both years. Therefore, the EPS 2008 is this number divided by this number, and we get 68.8 cents. Okay, let's determine the EPS for 2009. We start with our earnings attributable to ordinary shareholders, that is for 2009. We are told that it was 8.880 million. The number of shares did not change. Number of ordinary shares did not change. It was 12 million. Therefore, the EPS 2009 was this number divided by this number, and we get 74.0 cents. Now to answer our question, okay, we did calculate these ones. Then let us now determine the relative as well as absolute growth in EPS. So EPS growth with pen. Okay, EPS growth in absolute terms. Okay, absolute term, we just want to see how much was the growth. So the current growth, that's 74.0 minus the initial growth for 2008, 68.8. So this gives us a growth of, which is the difference, 5.2 cents. However, EPS growth in relative terms, okay, this one now, that's the difference, 5.2 over the original 68.8. Okay, and you can say multiply by 100% and you get 7.6%. In the exam, you're likely to be given 5.2% and you are going to fail if you choose that. So this is how you need, you have to do as a calculation for this problem. You need to do this to calculate your relative and absolute growth. All right, let's move on. We have already pointed out that these ratios, the earnings per share and so forth, they are usually subject to accounting manipulation because they are based on past data, okay, and accounting policies. All right, so accountants usually manipulate these figures. Remember, there is an aspect of creative accounting, which is a problem. Sometimes they refer to it as earnings management. So whenever you be using accounting ratios, there is that problem of creative accounting or window dressing, okay, where accountants will strive by all means to ensure that their accounts look nice when in actual fact they are dirty. So those are the problems that comes with the accounting package, but efforts are being done by many stock exchanges to ensure that the accounting reporting is actually valid and up to reasonable standards. All right, much of this in your notes. Let's move on to the other aspects which require explanations. Okay, ladies and gentlemen, let's talk of this area called working capital management. All right, this is another area which we need as finance managers. All right, we need to cover this area. It's actually of paramount importance. Remember, we talked about the issue of investment decisions as well as financing decisions. Working capital management actually falls in both these two sections, okay, or these decisions. We need working capital in terms of investments. How much working capital do we need for us to satisfy our short-term, day-to-day needs of the business? Okay, short-term financial needs. And then when it comes to the finance, how do we obtain the finance? Which avenues are available for us to obtain the short-term finance? All right, how long does it take for us to to use the money to purchase goods and then receive the money back as sales? All right, so how long does it take for our money to to get into that cycle? So that's working capital management, ladies and gentlemen. And basically, working capital is the name given to net current assets which are available for the day-to-day operating activities. It normally includes inventories. Let me look for another write up here. Okay, inventories, receivables, cash, and cash equivalents, less payables. Okay, so when you are asked to compute the working capital, you just have to know that it is okay. Working capital, it is inventories plus receivables plus cash minus payables. Okay, thus the amount tied up in working capital is equal to the value of raw materials, work in progress, finished goods, inventories, and accounts receivables less accounts payables. The size of this net figure is a direct effect on the liquidity of an organization. Net working capital of a business is its current assets less its current liabilities. All right, so this is why we say that working capital is actually the net current assets. All right, examples of current assets and liabilities. Current assets and current liabilities. Current assets include the cash or cash equivalents, inventory of raw materials, inventory of work in progress, inventory of finished goods, amounts receivable from customers, and marketable securities. Okay, and remember, a current asset is an asset that is to be used in the business for a period less than a year. Okay, when it exceeds 1 year, then it becomes a non-current asset. Current liabilities, we have got trade accounts payable, taxation payable, dividend payments due, short-term loans, long-term loans maturing within 1 year, and lease rentals due within 1 year. Here, we might have had a long-term loan previously, which had been a long-term loan for say 5 years, but in this current year, that's the year in which it is going to be repaid or it is maturing, then automatically it becomes a current liability because we have to service this loan this year. Okay, now cash operating cycle. The cash operating cycle is the period of time which elapses between the point at which cash begins to be expended on the production of a product and the collection of cash from a customer. The connection between investment in working capital and cash flow may be illustrated by means of the cash operating cycle, also called the working capital cycle. So in the exam, the examiner is at liberty to ask for this cycle as a cash operating cycle or a working capital cycle or a trading cycle or a cash conversion cycle. Do not be dazzled, okay? Do not be dazzled with that liberty of expression. They are examiners, they are the boss. So you just have to be prepared. I don't want somebody who fail because of those jargons. All right, so the way capitals, the cash operating cycle, ladies and gentlemen, is like this, as you can see on the screen. Okay, material is bought. That's what happens initially. The material is bought. Raw material becomes work in progress, which becomes finished goods. Then the goods are sold. Customers pay for those goods, and we got the man to pay our suppliers, and the cycle begins again and again and again. The question that comes is, how long does it take from the point we start buying those materials up to the point when we pay the suppliers, up to the point when we get our money back. That's the idea. Now, we need to appreciate this template, ladies and gentlemen, about the cash operating cycle of a manufacturing business. The cash operating cycle in a manufacturing business is equal to the average time that the raw materials remain in inventory less the time taken to pay suppliers. Okay, these are the payables. So we less them, remember, and then we have to add the time taken to produce the goods, the time taken by the customers to pay, okay, and then the cash cycle is determined. Remember, this is the period, it's in months. If the turnover periods for inventories and accounts receivables lengthen, that is, inventories and receivables levels increase, or the payment period to accounts payables shortens, payables level falls, then the cash operating cycle will be lengthen and the investment in working capital will increase. All right, now let's discuss about the length of the cash operating cycle in depth. The length of the cash operating cycle is often dictated by industry. For example, a construction business may have a long cash operating cycle because of the high level of work in progress. Okay, remember those companies like in our sunshine town called Bulawayo. Remember, Bulawayo in Zimbabwe is the seat of kings, okay, and queens. So there is a lot of real estate business that is going on. So companies in the construction industry, they are actually thriving, okay, but there is this risk of working capital problems. The construction industry, okay, has got a cash operating cycle which is a bit lengthy. All right, and because of this, this is because of the high level of work in progress. Okay, but on the other hand, we have restaurant businesses which usually have short cash operating cycles because their business is usually on a cash basis. Okay, cash, when we are talking of cash, we are referring to the fiat currency as well as plastic money. So there is the an issue of most of the transactions will be based on a cash and carry basis, but you can't do that in a construction industry. You need to spend more time building those houses or those flats, okay, and then customers will then have to come and buy those houses, which is actually a process that takes time. Please note that it is also possible to have a negative cash operating cycle. Don't say when you get a negative figure then you are wrong. You won't be wrong. The bookseller and retailer Amazon has a negative cash operating cycle because of short inventory periods and fast payment from customers. When Amazon ships a book, for example, it charges the customer's credit card and gets paid by the credit company within a day. But it doesn't mean that on that particular day they would have supplied the book to the customer. So money first comes and then inventories will be dispatched later. All right, let's do an example on these cash operating cycles. Okay, we have got this example, Bescom. Besco buys raw materials from suppliers that allow BES 2.5 months credit. The raw materials remain in inventory for 1 month, and it takes best 2 months to produce the goods. The goods are sold within a couple of days of production being completed, and customers take on average 1.5 months to pay. Calculate a base cash operating cycle. Okay, so we come here and say how many months. All right, so we need to establish the average days raw materials remain in inventory. Okay, and this we are told in the question that they remain in inventory for 1 month, so there is 1, and then we have to deduct the time taken to pay suppliers, time to pay, the time taken to pay the suppliers. We are allowed to pay within we are allowed 2.5 months credit, so 2.5. We are not allowed to exceed this period. Okay, and then we need to add the time taken to produce. Okay, time taken to produce. This is like time for work in progress. Okay, so it's like assets. Work in progress is an asset, so that's 2. We have to add. All right, because we take 2 months to produce, so that's 2. And then the time taken by customers. Time taken by customers before they pay us or to pay us. We allow them 1.5 months. Okay, so our cash cycle is 1 minus 2.5 plus 2 plus 1.5, which is equal to 2.0. So this is the cash cycle for our business. That's the cash cycle. So our cash operating cycle is 2 months. All right, and by definition, the cash operating cycle is the period of time which elapses between the point at which cash begins to be expended on the production of a product and the collection of cash from a customer. So in this particular business which we have just seen, we take 2 months. 2 months. All right, is it a healthy situation or not? It is determined by the industry. If our competitors are managing to get their cash within a month or less, when we are taking 2 months before we receive money from our customer, then we are at a disadvantage. Or if some of the branches of our company are receiving cash within a month and our branch is taking 2 months, then it means that we are not efficient. So you need to argue along those, based on certain comparisons, either based on industrial standards or company practice or company targets. Okay. Now let's discuss about the financing of working capital. Whatever level of working capital the business decides to hold, it has to be financed from somewhere. Remember I said working capital is also a financing decision. The business must decide whether to use short-term or long-term finance. Long-term finance is either raised from equity in the form of share issues, or from long-term borrowing. Short-term finance generally involves overdraft borrowing and or delaying payment to payables. Short-term finance is often cheaper, although not always. Interest rates on overdrafts can be very high, and delaying payments to payables can involve the loss of discounts. However, short-term finance is risky as it is repayable on demand. Okay, so the term demand, we are simply saying that if you take an overdraft, for example, overdraft. Let's say you have got a bank account with CBZ or ZB or Barclays, and they offer you an overdraft facility. An overdraft facility simply means that you are allowed to withdraw money beyond what you have in the account. Okay, let's say your account has got $2,000, which belongs to you, but then the bank allows you to withdraw 5,000. So the overdraft there was 5,000 minus 2,000, that is 3,000. So they allow you to take that money. But the problem is, when they want it, they don't give you a notice. All right? When they want it, they just take it. All right? They don't give you any notice. Okay? And if they are courteous and tell you that they want their money, they will be wanting it. Okay? So which means you don't have any room to negotiate. When they want it, they want it. All right. So which means if funds appear in your account and they want that money, they just take it any day, anyhow. Okay. So those are the nitty-gritties of the financing option. If you vie for overdraft, they know that when time comes, when they want their money, they simply take it and go. All right, so in the past, it was generally thought that since working capital involved short-term assets, it should be financed by short-term finance, whereas non-current assets being long-term should be financed by long-term finance. In recent times, the view is that, in fact, the overall level of working capital remains fixed in the long term, permanent working capital, and that there are day-to-day fluctuations above this permanent level, temporary working capital. Permanent working capital, being long-term, should be financed by long-term sources of finance. Temporary working capital, for example, if shop is increasing its inventory in preparation for holiday, should be financed by short-term sources of finance. So this is what is happening. We need to base our decisions in terms of fluctuations in our activities. All right, and when we want to engage in those activities which are a bit stagnant or constant, then we need to finance those activities with long-term capital or finance. Okay, for example, we know that from past history, we normally use about 5,000 US as working capital. All right, so we normally have to finance that using some long-term arrangement. Okay, but on the day-to-day, we normally see fluctuations in our day-to-day needs. Okay, so we also need to prepare for those fluctuations using some temporary working capital sources. All right, so please be careful. We are talking of permanent working capital. We are referring to long-term capital, working capital or capital needs. All right, and we should finance those long-term capital needs from long-term sources. of finance, for example, long-term debt or equity. All right. But when we are referring to temporary working capital, all right, we are simply referring to the short-term working capital needs. All right. And an example that is being given here is when we are preparing for inventory for sales during the holiday. We can't go and take a long-term loan, but we can arrange for an overdraft facility to be given to us. How do we measure the achievement of corporate objectives? Because we can't just go without, assessing if we are doing things right or not. So, as part of financial control in an organization, it will be necessary to have ways of measuring the progress of the enterprise so that the managers know how well the company is doing. A common means of doing this is through ratio analysis, okay, which is concerned with comparing and quantifying relationships between financial variables such as those variables found in the statement of financial position and statement of profit or loss of an enterprise. So we have got a broad spectrum of these financial ratios. We have got ratios dealing with profitability and return. Right? For example, we'll be here. We are looking at those ratios like the return on equity, the ROS, gross profit margin, operating profit margin. Okay, or the asset turnover. Or the return on assets, so forth. Those are the profitability ratios we'll be looking at. Okay, and then when we are talking of debt and gearing, we have got ratios like interest cover, financial gearing, for example, debt over equity, or leverage, where we want to see debt, the ratio of debt and debt plus equity. Those are the ratios we'll be looking at. And then we have got those ones to do with liquidity. And liquidity, we are looking at sometimes debt, financial gearing and leverage is just one and something, okay? The ratios are just considered to be one and the same thing, okay? Unless the examiner specifies what he wants, all right? They're just one and the same thing. They're also called leverage or financial gearing ratios. So don't be confused with that. Liquidity, we are talking of ratios like the current ratio, quick ratio. Okay, normally these two are the ones we'll be looking at. All right, although there are some other ratios related to cash flows and so forth, but just a bit of these are enough. There are also other ratios called efficiency ratios. All right, as part of this liquidity, we'll be looking at efficiency ratios. For example, the inventory turnover. We'll be looking at receivables turnover. We also have what are called inventory days, okay, number of days inventory or inventory days, receivables days, payables days. We also have payables turnover and so forth. Those are the ratios. They are in your notes. Okay, you need to assess them to see if we are doing things right or not. Okay, there are also other ratios which are called shareholder or investment ratios, which you are also required to know. For example, the dividend yield, and also that earnings per share is also an investment ratio. All right, so we are required to know those. Sometimes this return on equity is also part of the investment ratios. Okay, the dividend yield, I've spoken about that, which is the dividend per share over the market value of a share. And the dividend yield is often problematic. Let us find an example so that I explain that. The dividend yield. Let me find an example for that. Okay, the dividend yield. Dividend yield is equal to dividend per share over XDIV, market price per share. When you're talking of XDIV, this is the price of the share after the dividend has been paid. After the dividend has been paid, there is an expectation that the share price would move, okay, usually downwards. Okay, so we want to determine the dividend yield after a dividend has been paid. The dividend yield is the return a shareholder is currently expecting on the shares of a company. The dividend per share is taken as the dividend for the previous year. Ex-dividend means that the share price does not include the right to the most recent dividend. Shareholders look for both dividend yield and capital growth. Okay? Remember, in our total shareholder return, we mentioned that there is the current return as well as the capital return, because shareholders are interested in both of these returns. They want to see this. Okay, the current return is actually something that to some extent related to the dividend yield, although the difference is that the current return is based on the original share price, not the current share price. The dividend yield is based on the current share price after a dividend. Obviously, dividend yield is therefore an important aspect of a share's performance. Now, let's look at this example and see what is going on. In the year to 31st March 2022, an advertising agency declares an interim ordinary dividend of 7.4 cents per share and a final ordinary dividend of 8.6 cents per share. Assuming an ex-div share price of 315 cents, what is the dividend yield? And we know at this level that dividend yield is equal to dividend per share over ex-div market value of the share. So we are told that there was an interim dividend of 7.5. An interim is a dividend that is paid during the year, and then there was a final dividend at the end of the year. So in total, the dividend that was paid was 7.4 plus 8.6 which is equal to 16 cents. Therefore, the dividend yield, remember, is equal to DPS, that is 16%, 16 cents, right, over the ex-div market price of the share, okay, multiplied by 100, and we get 5.1%. Now let's talk of this as a recap, because we have been talking of the earnings per share, but it has got its brother, the price earnings ratio. Earnings per share is equal to profit distributable to ordinary shareholders over the weighted average number of ordinary shares. Profit distributable to ordinary shareholders is the same as earnings attributable, because we have been using this term, earnings attributable to ordinary shareholders. So it is just the same as profit or profits distributable to ordinary shareholders over weighted average number of ordinary shares. The use of earnings per share was discussed already. All right. Now let's talk of this new brother of ours, which we didn't discuss all along. That is the price earning ratio. The price earnings ratio is also an investment ratio or a shareholder ratio. Remember, in the classes of these, the classes we've been talking about, the ratios, okay, it is part of the stock market ratios. So the earnings per share is considered there. I mean the price earnings ratio. All right, price earnings ratio is equal to market price of share divided by the earnings per share. So this is why I say that they're like brothers. They are related somehow. The price earnings ratio is just the ratio of the market price of the share to the earnings per share. All right. So the price earnings ratio is a useful yardstick for assessing the relative worth of a share. This is the same as total market value of equity over total earnings. Sometimes you are not given the price per share, but you are given the market value of the firm as a whole. You mustn't be dazzled by that, because that's how it is and that's how it might be presented. Okay, you just have to know that when you're talking of market value of equity, we are also talking about the market price of a share. All right, the difference is that one would be representing the whole company, whereas another one would be representing an individual share. All right, then when you're talking of total earnings, these are the total profit that has been made, but we can as well determine the profit per share, which is the earnings per share. Okay, the value of the price earnings ratio reflects the market's appraisal of the share's future prospects. It is an important ratio because it relates to key considerations for investors: the market price of a share and its earnings capacity. Okay, so that is the case. Let us look at this particular example and see if we are getting it right. A company has recently declared a dividend of 12 cents per share. The share price is 3.72 cum div, and earnings for the most recent year were 30 cents per share. Calculate the price earning ratio. the price earnings ratio. So we know price earnings ratio is equal to market value. Okay, remember these market values per share are XDIV, market value XDIV over earnings per share. Market value of a share over earnings per share. So the market value XDIV is not given, we are given the cum div. Cum div means before dividend, whereas XDIV is after dividend. So please get this right. So this means we need to adjust 372 minus the dividend, which was 0.3, that's 30 cents. Okay. Okay, excuse me, I picked a wrong figure. This one is not dividends. The dividends is there, 12 cents, 0.12. All over, this one is the earnings per share. The earnings for the most recent year was 30 cents, so 0.3. So we get in brackets 360 over 0.3. This means 12. So price earnings ratio is presented in times. So that's 12 times. Not in dollars or percentages, but times. Okay? And always remember that we are going to use the XDIV price. Why? Because this price reflects the underlying value of the share. Okay, so that is the issue. You might also be asked to discuss the limitations of ratios. Okay, the limitations of ratios. And in the exam, you mustn't panic. You just have to discuss these things with the free will. Okay, with the requisite free will and confidence. Now, the use of statement of financial position is dangerous in that it represents only one point in time, which may be unusual. Okay, due to, for example, seasonal factors. Let us say there is a company that is usually seasonal in its operations, and when we use the statement of financial position for a period when its sales were so high, it might give us a wrong impression of that company. We might say the company is a profitable business when in actual fact we only use the information at a point in time when its operations were so favorable. So that's the point we are trying to drive home here. There might be a lot of window dressing. Remember, we talked of earnings management. Accountants are creative in the way they do their reporting. All right, so unless well supervised, the process might be manipulated. The ratios only look at the past, not the future. So that's another limitation of ratios. They are of little value unless used in comparisons. This is why I say that you need to some extent compare the results with those of industry or other competitors or other departments. Okay, now to wind up this working capital management topic, let us do this last question. The table below gives information extracted from the annual financial statements of Acca PLC for the past year. Acca PLC extracts from annual accounts inventories, purchases, cost of goods sold, sales, receivables, payable. Calculate the length of the working capital cycle assuming 365 days in a year. So this time we are not given months, we are not given periods, but we are given money. So we need to convert this money into days. Okay, we need to convert the amounts given there, the monetary amounts, into days. So in other words, the examiner has asked us to calculate certain efficiency ratios. Okay, certain efficiency ratios. What we know is that working capital cycle is equal to assets minus liabilities. Okay, assets days minus liability days. Sorry. That's what happens in short. That's the working capital cycle, ladies and gentlemen. So let us determine this information. The first, when we are talking of assets, we are talking of inventories, we are talking of receivables, we are talking of the cash itself, and so forth. Then we are talking of liabilities. We are mainly referring to payables. So this is the information we are talking about. Now, let's calculate the receivables days. Receivables days. This one is given by receivables, usually credit receivables. Sorry, credit sales. Okay, receivables are actually credit sales. Please know this. So receivable days, we are talking of credit sales. So if you are given a sales figure, try by all means to determine the credit sales figure over credit sales. Okay, so what is the difference between the receivables and credit sales? All right, the receivables, ladies and gentlemen, these ones, we know that they were credit sales, but not paid. Okay, and then these ones, they were credit sales, total credit sales during the year. Some have been paid, some have not been paid. Okay, so that's the difference. Receivables, they are credit sales, but which are not yet paid, over the total credit sales during the year. I hope this explanation is not confusing somebody. Okay, multiply. So receivables over credit sales multiply by 365 days. So in this case, the receivables were how much? Receivables were 172, and the sales now, okay, want the credit sales, but we can safely assume that these sales were credit. So let us try to determine the receivables days. Okay, so that's 172800 over 86400, and this gives us 73 days. We move on to the inventory days. Inventory days, this one is given by inventory value over the cost of sales. Multiply by 365 days. And this gives us the inventory value was 108 over the cost of sales 756. 108 over 756. Now remember, don't forget to multiply by 365. Okay, multiply by 365 days, and we must get 52 days. Then from the scenario, we have got payables. So payables days is equal to the amount, the payables amount over credit purchases multiplied by 365 days. And this means the payables 86,400 okay, divided by credit purchases. Okay, the assumption is that these purchases were on credit 518,000 multiplied by 365 days, and we get 61 days. So the net operating cycle, okay, let me use this space. Net operating cycle is equal to this amount 73 plus this amount 52 minus this amount 61. Okay, let us determine the value there. 73 plus 52 minus 61, we get 64 days. So simple, isn't it? Very simple. Now let's move on to explain two terms here. There is overcapitalization and overtrading, which normally becomes problematic, related to this working capital management. Overcapitalization is where the overall level of working capital is too high. For example, too much inventory or cash are being held. Although this will tend to mean that the business can always easily supply customers and there is lots of cash for emergencies, there are risks associated with this. Inventory can go out of fashion or deteriorate or become obsolete, so that sales become difficult. Cash sitting needlessly in a bank account is wasteful, and better use of and better use could probably be made of it, for example, by updating machinery, repairs, maintenance, um, to make the business processes more efficient or production processes more efficient. The solution is to reduce the level of working capital by better management of receivables, cash, and inventory. As a result, the company will need less financing or alternatively will have more finance available for profit-earning investment in non-current assets. Okay, what about overtrading? Overtrading or undercapitalization is where the level of working capital is too low. In contrast with overcapitalization, overtrading happens when a business tries to do too much too quickly with too little long-term capital so that it is trying to support too large a volume of trade with the capital resources at its disposal. For this reason, overtrading is sometimes referred to as undercapitalization. So when we are very ambitious, too ambitious, such that we just want to grow quickly but without enough capital to fund our path, to fund our energy, we end up resulting in what is called overtrading. So even if an overtrading business operates at a profit, it could easily run into serious trouble because it is short of cash. Such liquidity troubles stem from the fact that it does not have enough capital to provide the cash to pay its debts as they fall due. Okay, please watch out for these terms. They are usually rich examples at this level. All right, these are the symptoms of overtrading. When you see a business that is having some rapid increase in sales revenue, try to suspect overtrading. Maybe it is offering too generous terms to its credit customers, such that they are coming to hoard everything without paying the business any cash. There is a rapid increase in the volume of current assets and possibly also non-current assets. Even the turnover and accounts receivable turnover might slow down, in which case the rate of increase in inventories and accounts receivables would be even greater than the rate of increase in sales. This is another symptom. There's only a small increase in equity capital, perhaps through retained profits. Most of the increase in assets is financed by credit, especially trade accounts payable. The payment period to accounts payable is likely to lengthen. A bank overdraft, which often reaches or even exceeds the limit of the facilities agreed by the bank. Some debt ratios and liquidity ratios alter dramatically. The proportion of total assets financed by the proprietor's capital falls, and the proportion financed by debt increases. The current ratio and the quick ratio fall. The business might have a liquid deficit that is an excess of current liabilities over current assets. When you see these symptoms, just suspect overtrading. Encouraging the achievement of stakeholder objectives. How do you encourage the achievement of stakeholder objectives? Okay, this could be done through several ways. Okay, you could have good reward systems to managers. Remember, managers are essential stakeholders of a firm. Okay, management. So if they are rewarded nicely, then they could actually perform in line with the shareholder expectations. All right, so for example, if we give them performance related pay, it means that they get good perks, but at the same time they are also being directed to the objective or strategy of the firm. they will be directed to the interest of the organization. All right. So that's the benefit of performance linked rewards. Okay, but there are also dangers related to these reward systems. You just have to be aware of them. Okay, a serious problem that can arise is that performance related pay and performance evaluation systems can encourage dysfunctional behavior or some box ticking approach. Many investigations have noted that there was a tendency of managers to pad their budgets either in anticipation of cuts by superiors or to make subsequent variances more favorable. So please read around that area, okay, of these performance reward systems or rewards which are linked to performance. Okay, there is also an issue of regulation in the financial or business environments. The achievement of stakeholder objectives can be enforced using regulatory requirements such as corporate governance codes of best practice and stock exchange listing regulations. Those might also assist. Okay, regulation is also useful. All right, we also need things like stakeholder engagement and so forth. Finding ways to ensure that various stakeholders are engaged whenever we conduct processes which affect them. We need to consider their views as well to engage the stakeholders, okay, in some of the decisions which affect them. All right. Talked of the corporate governance issues, and we need to be comfortable with those ones. So, ladies and gentlemen, I think for now we have done this part, and let us now see one another in the next part, where we'll be talking about those methods which are essential in the working capital category, but with the idea or with the mentality of attending to the issues which we raised here. Okay, there has been some, when we talked about shall we have a lot of working capital in our coffers, at what amount of inventory shall we have, okay, when shall we order, and so forth. All right, those what quantities of receivables shall we have. That's another segment of working capital management where we'll be doing a lot. We'll be touching a lot of things related to the computations, because we need to be very specific in terms of the inventory quantities and when shall we have to order those ones. So that's the notion of the economic order quantity, the issues to do with receivable management and so forth. So we need to dedicate a special video for that part. So until next time, ladies and gentlemen, may we continue to feel very excited. So see you in the next video on the other aspects of working capital management. Thank you.